Alrighty, if you're looking for stocks that pay you a reliable source of cash every year through a dividend, then you've come to the right video. Today we're going to be taking a quick look and comparing 5 different stocks that have each increased their dividend every year over the past 50 years. You've probably heard of the Dividend Aristocrats, a group of S&P 500 stocks that have increased their dividend every year for the past 25 years. But you may not have heard of the Dividend Kings, a group of stocks that have each increased their dividend every year for the past 50 years. They're not necessarily in the S&P 500, it's not an official index such as the Dividend Aristocrats, but the Dividend Kings have stood the test of time and have provided investors with stable, predictable cash flow for decades. Just a quick disclaimer, this is not investment advice, and I currently don't own any of these stocks. I've just been researching them, and I'm just sharing some of what I've found. Definitely do your own research before buying any stock. And if you're an investor who manages your own portfolio, be sure to check out the free daily newsletter by clicking the link in the description below. Now let's get on to the video. The first stock we're going to be taking a look at is ABM Industries. ABM is a provider of facility solutions with revenues of approximately $6.5 billion and about 140,000 employees. ABM provides various services to its clients such as facilities engineering, janitorial, HVAC, and electrical. ABM has increased their dividend every year for the past 55 years and currently has a forward yield of about 1.83%. Which equates to about 88 cents a share. Its most recent dividend increase was at 12.8% from the previous dividend, and its dividend has a 20-year compound annual growth rate of about 4%. Its forward payout ratio, which is a ratio used to examine if a company's earnings can support the current dividend payment amount, is at 22.22%. This just means that they're paying out about 20% of their earnings. This is calculated by taking the dividend per share and dividing it by the earnings per share. This ratio can help you avoid a dividend value trap, which is when a company looks like it's paying a very high dividend, but it's most likely not going to be able to sustain that. I also want to note that Dividend.com uses the forward payout ratio, and that's based on the company's future projections. That way we're looking ahead. Are they going to be able to pay out the dividend in the future, and not necessarily looking at the past data. ABM currently trades at a PE ratio of about 14, and over the past 5 years, its stock has appreciated about 37%, which is a little more than half of what the S&P 500 has done. Next up, we have Illinois Tool Works. ITW produces thousands of products across a variety of industries. They have more than 18,000 patents, and they're typically in the top 100 patent issuers in the US. Their products range from fasteners to consumable systems and other specialty products. They also own a number of notable brands, including Hobart. ITW has increased their dividend every year for the past 59 years and currently has a forward yield of about 2%, which equates to $5.24 per share. It has a 20-year compound annual growth rate of just under 13%, which is far better than ABM. Over the past 5 years, its stock has appreciated just over 56%, which is close to but slightly below what the S&P 500 has done. It's about twice as expensive as ABM is, with a PE ratio of over 28, and its forward payout ratio is just under 53%. Between the two, I definitely like Illinois Tool Works more. They seem to have a moat with their patents, and it's not as people dependent as a facilities manager, but it is twice as expensive, so it's definitely something to take into account. Alrighty, next up we have Nordson Corporation. These guys design and manufacture dispensing equipment for consumer and industrial adhesives, sealants, and coatings. The company also manufactures equipment used in the testing and inspection of electronic components, as well as medical devices and component technology. Nordson has increased their dividend every year for the past 59 years and currently has a forward yield of just over 1%, which equates to $2.60 per share. Forward payout ratio is just under 26%, and their dividends compound annual growth rate for the past 20 years has been just under 11%. Currently has a PE ratio of 28.4%, and over the past 5 years, its stock has appreciated almost 84%, which is far better than the S&P 500. Next on our list to go over is Colgate-Palmolive. They're most famous for their toothpaste, but they own numerous other household, healthcare, personal care, and veterinarian products. The company has increased their dividend every year for the past 60 years and currently has a yield of just over 2.5%. Which is about $1.88 per share. It's got a forward payout ratio of 55%, and its dividend has a compound annual growth rate over the past 20 years of 8.5%. The company is currently trading at almost a 35 price to earnings ratio, and over the past 5 years, it's been fairly stagnant, only increasing 5.7%. Last up is S&P Global. S&P Global is most known for the S&P 500 index, as well as their ratings. They also have numerous other divisions, including S&P Global Market Intelligence. The company has increased their dividend every year for the past 51 years, and currently has a yield just below 1% at $3.60 a share. They've got a forward payout ratio of almost 25%, and their dividend has a compound annual growth rate for the past 20 years of 9.8%. It's currently trading at a price to earnings ratio of just over 32, and over the past 5 years, its stock has more than doubled. I like S&P a lot. The ratings business is a great business to be in because there's only a couple competitors. Warren Buffett has famously owned Moody's, one of S&P's competitors, for years now, and it's been a core holding of his. In addition, S&P has been diversifying their revenue over the past number of years. All right, to summarize, I like all 5 of these, which is why I chose to include them in this video. Maybe one of these 5 stocks interests you and you can go and dig further deep into it. I really like S&P, Colgate, and Illinois Toolworks. When you look at PE, those 3 are very expensive. But Terry Smith, which is one of the UK's top investors, pointed out a couple years ago that an investor could have paid a PE ratio of 281 for L'Oreal and it still would have achieved a 7% compound annual growth rate. So that just kind of goes to show that even though it's expensive stocks might be worth paying up for. Thanks for watching. Please leave a comment with any suggestions you may have. Tomorrow I've got a video coming out that goes over the SaaS industry. Enjoy the rest of your guys' day.